Hello and welcome to YPC TV's Property News Update UK edition. Today's the 4th of November 2010 and I'm Brett Alegre-Wood. Well, it's good to be back after a month of travelling through 7 countries. I was busy planning the setup of 5 new YPC offices in Asia and the Middle East, as well as supporting our Aussie office and doing some fundraising for the British Enterprise Bank, which you may have seen all over the news while I was away. You'll also notice that I'm sporting 4 days worth of growth on our Movember charity challenge. So you just jump onto ypcgiving.org for more info or sign up and join us and raise money for men's prostate cancer. Okay, well, this week what we're going to cover. Firstly, the government's comprehensive spending review. We'll take a look at that, the pluses, the minuses, and what I think about that. We're going to look at house prices rise the fastest in 18 months, okay, in September. We're also going to look at house prices fall again, all in the same month. We're going to look at remortgaging activities picking up and why we need first-time buyers back in the market ASAP. But why 45% of mortgages wouldn't have been approved under the FSA criteria, the criteria they're actually proposing now. So, yeah, scary stuff, but we'll look at that. Okay, so let's get into it. So, first of all, the key spending review announcements. Look, for the most part of this, it's absolute rubbish. Forget about it. The market's already priced everything in. Everyone already knows what's going on there. So actually, to be fair, it's already accommodated. If you look at all the GDP, if you look at any of the figures, they've already allowed these in. Okay, so don't even worry about them one little bit. And just to have a look, I want to have a look at some of the little graphs they give you. So this is the graph here. So if you have a look, this is government spending, and what you found is government income has dropped, spending has shot up. Now, spending is good in a recession, all right? The problem is, and this is where the problem started, way back here, yeah, where what actually happened was rather than putting money aside, the government spent more money than they borrowed. Okay, and that continued and that gap widened, and at the end of the day, that's the biggest mistake that they've made, and that's Blair and Brown, and this is the hangover that we've got now from their pathetic, terrible leadership. Okay, economically, absolutely terrible. Politicians, fine, you know, they certainly stayed in for far too long. Now, the forecast here, obviously, they want to take the spending down, whilst the income will recover slightly. So, you know, the income through taxes and all sorts of things. And actually, when we take a look at there's actually a graph that I've got on this as well. So, on the one side, we've got spend on. So, this is where they're spending the money. Now, you'll notice that big red section there on the left-hand side is actually government debt interest. So, that's the borrowings that they've got, okay, the interest they're paying. So, that just goes nowhere, okay, that just services the debt. And you can see where's the money raised from, okay, so this is almost 700 billion is our budget, all right. So, if you imagine you earn £20,000 a year, all right, the government's £20,000 a year, the equivalent is £700 billion. All right, now it's not actually because they're borrowing more than they spend. All right, their actual stuff is probably about, let's say, 600 billion, but they're able to go and borrow, which obviously means that little red bit is increasing. All right, so that's just some quick figures. Look, for the most part, you and I as investors, it makes no difference. It means nothing. Don't even worry about it. Okay. It's already been factored in. It's already going to happen. The most important thing to understand with the government spending and the comprehensive spending review is this. Okay, they have said that over the next 4 years they want to correct it. Now they've got the choice. They can either make all the cuts now. 500,000 public sector employees they're looking at getting rid of. Okay. Now interestingly, how many did they employ in the first half of last year? It was 300,000. Employees. So actually 500,000 is not a huge amount. Look, it is a huge amount, and there's a lot of people going on to the unemployment line, if you like. But in fact, a lot of these aren't going on the unemployment line. They'll naturally leave, they'll retire, they'll do all this sort of stuff, which will shrink the ability. So actually the actual job cuts where they'll be cutting wholesale amounts, it will happen. There is a lot of people, no doubt about that, but actually isn't as much as people may think. And certainly there's still a scaremongering going on, but hopefully all of us, okay, and certainly if you're working with us, your level of awareness and your education should be raising. You shouldn't be too worried about it. All right, the important thing here is they could make all the cuts up front, all right, which would send us into a tailspin, but it would get rid of it, get it all fixed up, and then what we'd have is this gradual, and it'd probably be a very long one. But what they need to do is they need to make the cuts, but at the same time increase the revenues, all right? And if they do that successfully, then fantastic, okay? And that's the important thing here for us. And I think, to be fair, I think they are going to do a good job of it. And I think we've got to give them the time and the ability to do that, okay? And certainly we do that. I think we're, not heading out like this, but certainly slow and gradual. And my prediction, okay, whether I'm right or wrong, we'll see. But I think by the middle of 2012, we'll be back into what I would call normal business, okay? Certainly now, the business is subdued. It's not quite what it is, but it will get better, all right? So really nothing to worry about. House prices. Now, I've been saying this for, a year now probably. House prices, the increases we've seen are rubbish. It's coming back down now. But then you see things like this. House prices see fastest rise in 18 months. Now, forget about it. They dropped 3.7% last month, and then October, 1.8% they grew. So whilst they grew, now, if you average those out, and certainly I'm not one to take 1 month as being, the be-all and end-all. What I do is track trends, all right? And I'm very good at tracking trends, and that's what I do. I look over 3 months, 6 months, 12 months, okay? And, we're still in positive territory with house prices for this year. For me, they've bounced along the bottom. They haven't increased, they haven't decreased, and that, I think, is where we'll finish the year off, okay? And then, obviously, another one, house prices fall, okay? Now, interestingly, if you look, this is the regional variations. The fastest growing is London, 8.8%, all right? The smallest increase is 0.2%. That's in the northeast, all right? So, there's a huge gap of 8.6%, difference there. But look, with that, it is going to continue, and I think it will continue till the middle of next year before we'll start to see, actual prices recovering and that sort of thing. Because we've got the VAT increases coming in January. That's going to prop up the GDP, but I think we'll see the drop in GDP the second half, which will keep things subdued. And I think by the second half of next year, lending should be returning to normal. We saw Lloyd's pay back, I think it was £5 billion to the government, to the Bank of England. Which was good news. They've actually made that commitment as opposed to having to get, and what they did is they raised that money on the open market, which is good because if the wholesale markets start moving, then the retail markets can start moving, which is good for all of us, okay? All right, so yeah, house prices, same. It's all over the place anyway, all these house price things, but don't believe them. House prices on the trends are going down, okay? And down, not because they're realistically going down, but because they've actually been going up artificially, I think. All right, the number of remortgaging is increasing. Look, more and more people are going back and remortgaging because of the pre-crash mortgages they've got have now turned on to standard variable rates and things like that. So, and rates have started to come down. There's more money circulating. Things are getting back on their feet. This will continue. There's a bit more competition coming back. So remortgaging, is something. Yes, you can look at it, but what I'd be saying is speak to a mortgage broker. Don't just think because you see a thing like this that you need to go out and remortgage. You don't. All right? More needs to be done to help first-time buyers. Look, until we get this sorted and get first-time buyers happening and back into the market, all the reports that are coming out now are talking about, the average age going from 34 to where it's 37 now to where they reckon it'll be above 40, okay? Now, if they want to help this out and if the government wanted to really do something, and this is the thing, their hands are tied in a way because they haven't got the money to spend. They've got no money to do stimulus with, okay? If they wanted to, they'd do a first-time owners grant. They'd do a, something like this which provides for, a certain percentage of the deposit. Or, if they did something like this and stimulated that, and maybe up to, a £300,000 house. So stuff in London, can't do. But stuff outside London, you can look at that. If they did stuff like this and stimulate the first-time buyers, we'd get them back, and that could kick the market very slowly. But the thing is, the banks are very reluctant to lend right now, and they will be, I think, until the middle of next year. I think by that stage, we'll start to see some competition coming back where it'll be visible. There is competition coming back, but it's a lender here, a product there, dropping the rate here. Okay, it's not what I would call, a perfect market or perfect economy right now. All right, so this one, look, Yeah, FSA. 45% of mortgages may not have been granted this year under the FSA's Mortgage Market Review, MMR proposals. All right, and what they're saying is they go through it. Look, if the FSA gets away with what it's trying to do now, then 45% of the mortgages this year would not have been approved, which would have made things even worse. Prices would have gone into a tailspin. The economy wouldn't know what to do. It's a bunch of monkeys running this FSA. They've just totally lost the plot. They're not in touch with reality, and really they're totally knee-jerk reaction type things. And, I just wish someone would jump in there and actually, go about this in the right way and actually try and stimulate business while, yes, regulating. But, any company or any organisation that says, yes, we'll regulate you, but what we'll say is we won't tell you what regulation means. We'll give you a set of principles and then you go out and do it. And if later on we find out they're wrong, well then, we'll sue you, or we'll, take you to court, or we'll close your business down or fine you. It's ridiculous, okay? It's absolutely ridiculous. And what it means is you're constantly trading with a cloud over your head, and you don't need that, especially in this type of market. All right, guys, excellent. Have a fantastic week, and I'll see you again next week with a nice 2-week growth. See ya.